Walk us through your $300 silver target roadmap. What takes us there?
The industrial consumers need their silver. The investors don't technically need their silver. Industrial consumption has gone from 50% to 67%. It squeezes out the amount of silver that is left over for investors. Silver's in cornea replacements in our eyes because it's a biocide. It kills bacteria. Solar panels, there are issues with copper. The next time it gets to 50, it's going to ultimately see that as a new floor. Everything that's led to where we are now has been more than anything fundamentally driven with these supply deficits, silver being deemed a critical mineral by the US, China controlling 60 to 70% of silver refining, the US looking at spending $2.5 billion on a critical minerals, a strategic minerals stockpile, Trump telling his trade advisors we should consider the idea of price floors on these critical minerals. India now saying that you can use silver as bank collateral. You've got people like Bank of America. He's saying we could see anywhere from $135 to $309 this year.
Walk us through your $300 silver target roadmap. What takes us there?
So what takes us there ultimately, I believe, is a mania phase. You know, I'm not trying to call for numbers like that to be sensational. When I wrote the book, I took the time to make a forecast. And I looked at what happened in 1980 and I thought, you know, not unreasonable. I'm not talking about price right now, but not unreasonable to see similar kind of behavior, right? And so when you get to the end of a bull market, things go crazy and people will pay anything for an asset. And it's the end of the bull market, but it's the mania phase of the bull market, right? So you get these huge run-ups in a very compressed amount of time near the end. And that's what we've seen several times in silver, but in other markets as well. You know, you can talk about housing, you can talk about the internet bull at the end of the 2000s. It's not unlikely to happen again. And so, frankly, what I did was I looked at what got silver to that peak. And what are the indicators? What are the ratios and other things? How did it compare to other assets at that time?
Mania phases don't start with euphoria. They start when fundamentals quietly overwhelm supply. Peter Krauth frames this not as hype, but as a behavioral pattern markets repeat when scarcity meets momentum. History backs that up. Silver's biggest gains in 1980 and 2011 occurred in the final 10 to 15% of the bull cycle, not the early years. What matters for investors is that these blow-off moves compress years of upside into months, distorting risk perception. Portfolio timing becomes more important than conviction here. Peter Krauth is essentially warning that late-stage gains reward patience early, not panic late. And next he explains why recognizing mania early is harder than most investors think.
So the gold-silver ratio bottomed at 15 to 1, meaning it took only 15 ounces of silver in 1980 to buy 1 ounce of gold. The Dow ratio, the Dow to silver ratio bottomed. The average home price to silver ratio bottomed. So what all of that meant was silver had become way overpriced, because it took, on average and historically, much fewer silver ounces to buy these other assets.
Okay.
So one good example is the gold-silver ratio.
Yes.
So 15 to 1 in 1980. And so I said, all right, if I'm going to use that as some kind of an indicator of where silver could go, for gold, I'm going to have to make an assumption of where the gold price would go.
Yeah.
So here's what's interesting. At the time, and it's in the book, I said, ultimately, I think gold can go to $5,000. Where are we today, David?
Did you have a timeline in mind for when that would happen? I mean, we're at 5,000 today. Maybe
right.
It exceeded your initial estimates of how fast it could get there?
For gold, absolutely, it exceeded it.
Ratios don't scream headlines, but they quietly expose asset distortions Wall Street avoids discussing. Peter Krauth highlights that when silver prices assets cheaply across gold, stocks, and housing, it signals excess, not value. The gold-silver ratio, hitting 15 to 1 in 1980, wasn't bullish discipline. It was speculative distortion. Today, gold reaching $5,000 far earlier than expected shows how fast monetary stress accelerates once confidence cracks. Investors focusing only on price missed the structural signal ratio send about overheating. Peter Krauth is reminding investors that relative valuation often warns before price peaks do. And what comes next reframes why timing matters less than positioning.
I thought we would be there in several years still from now. I love the work that Ronnie does with the In Gold We Trust report. And I think it's a 2021 issue or so. They talk about their forecast for gold, and they give a probability to it. And their forecast was, I think, something like $4,980. Well,
Yes, that's right.
We've surpassed that. And I remember you asking me about that.
I spoke with him yesterday, and when he made that call, people thought he was crazy for making a $4,980 gold price call, which, now that I think about it, was $20 off from just 5,000. I'm not sure why he didn't just round up. Anyway, that's a conversation for him. But
exactly.
People were skeptical even about the $5,000 gold call. What were people's responses to you initially when you made that call in your book, and I guess also in your private conversation?
Similar. How can you say it's going to get to these kinds of levels? What's going to drive it there? It's going to mean chaos. It's going to be World War III. Now, some people might argue, in some ways, maybe we're getting close to that.
Yeah.
But, that doesn't change the fact that we've reached it. And we've certainly reached it earlier than I thought, but we're there now.
Markets ridicule forecasts right up until they become consensus. That's the pattern being exposed here. Peter Krauth points out how expert projections are dismissed not because they're wrong, but because they arrive too early. Gold crossing $5,000 ahead of schedule reflects liquidity stress, debt expansion, and declining trust in fiat systems, not sudden optimism. Investors should notice how disbelief persists even after targets are hit, delaying portfolio adjustments. This is how risk quietly transfers from institutions to retail. Peter Krauth is underscoring that speed, not direction, is what catches markets unprepared. And next, he explains how silver inherits that acceleration effect.
And so my assumption when I looked at the gold-silver ratio was that I thought, okay, gold could peak conservatively at $5,000, and if you have a 15-to-1 ratio, that was $333 silver.
Yeah.
So that's one indicator. I can't remember the numbers specifically that I used for the Dow silver ratio. I'm pretty sure in the average home price to silver ratio, it was something like 1,400 ounces of silver at the peak in 1980 to the average home price in the US. At the top, when silver was $4 in 2001, it was about 44,000 ounces of silver that it took to buy the average home price, average home in the US. I believe, and if you only take, this is without home prices increasing, if you go back to the 1,400 to 1, 1,400 silver ounces to the average home price of, let's say, $500,000 US, you're at $300 silver.
Right.
So there were multiple indicators that all said to me, that's the kind of range realistically that I think ultimately we could reach in a mania phase for silver.
When will this mania phase come? Does your model predict timing at all?
It does not.
Okay.
No. I mean,
well, let's frame it in different ways.
This isn't a price target pulled from emotion. It's arithmetic across asset relationships. Peter Krauth lays out how silver's purchasing power against homes and gold has swung wildly before, often overshooting fundamentals during manias. In 2001, silver buying power collapsed to 44,000 ounces per home, a level reflecting extreme undervaluation. Reverting even partway creates explosive upside without assuming economic collapse. Investors should recognize this as mean reversion logic, not prophecy. Peter Krauth is careful to avoid timing because valuation resets rarely respect calendars. And next, he explains why waiting for certainty usually means missing the move.
So you mentioned a deficit earlier. Deficit from what? Industrial or retail demand?
So the deficit, demand overall is in deficit.
Demand
industrial,
from the industry side or retail
so combined,
side,
combined, but industrial doesn't really have too much in the way of options.
Yeah.
Industrial uses silver. Silver is difficult, if not impossible, to substitute in many, many cases. So the industrial consumers need their silver. The investors don't technically need their silver. But what has happened is that just in the last few years, industrial consumption has gone from 50% of the overall demand to 67% of overall demand. So what does that do? It squeezes out the amount of silver that is left over for investors. So what does that do? Well, when investors start to come back into the market, like we've seen over the last sort of 5-6 months, is that it squeezes the price of silver up because there's less silver available for the investment side. Because the industrial consumers, believe me, they're not going to do without their silver.
Yeah.
They absolutely need it to get the product out, and they'll get it. So that's why I say that the investment side of it can ebb and flow, but when it flows, look out, because that can really push silver prices higher.
Silver Institute and a lot of other publications have made the assumption that we're going to get a deficit because demand will stay constant, if not higher, and grow.
This deficit isn't about investor hype. It's about industrial demand quietly cornering the supply. What stands out here is how industrial usage has climbed from 50% to 67% of total demand, leaving a shrinking pool for investors. Something Peter Krauth has warned often gets ignored in mainstream coverage. Unlike investors, factories can't just walk away, and that rigidity creates asymmetric pressure when capital flows back in. Over the last 5 to 6 months, even modest investor interest has amplified price moves because supply is already spoken for. This dynamic matters more than sentiment cycles, and Peter Krauth highlights that this structural squeeze doesn't unwind easily. What he explains next shows why this imbalance may catch late investors completely off guard.
I would argue that at $100 silver, industry is going to look for ways to thrift. Can we factor that in?
Yeah, I mean, no, I wouldn't discount that at all. Frankly, I think that's a realistic concern. But I think the concern comes mostly, if we're going to look for sectors, is going to be something like the solar panel sector, because a lot of other industry that consumes silver consumes it in very, very small quantities for each unit that they produce, whether that's a cell phone or, silver's in cornea replacements in our eyes because it's a biocide. It kills bacteria. So you'd have to imagine there's not that much silver in these kinds of things, in a microprocessor, any of that stuff. But solar panels, when silver was $30, $40, represented about 20% of the overall cost of a solar panel. That wreaks havoc on the industry. So I've been reading reports lately about how many of them are getting anxious about it. They are looking to thrift, but to be fair, they've been thrifting for years and years. We've seen the amount of silver going into a solar panel just diminish, but that has been flattening. So they're looking at other things. They're looking at copper, for example. There are issues with copper, several. One of them is the fact that copper is not as efficient.
Yeah.
Second thing is that copper corrodes.
The idea that $100 silver kills demand sounds logical, until you see where silver actually matters. As Peter Krauth has pointed out, most industries use microscopic amounts of silver, meaning price spikes barely register at the unit level. Solar is the exception, where silver once made up roughly 20% of panel costs at $30 to $40, and that's where anxiety shows up first. Yet even there, years of thrifting have already flattened, not eliminated, silver use. Copper substitutions bring efficiency losses and corrosion risk, raising life cycle costs rather than solving them. A nuance Peter Krauth stresses often gets overlooked. What comes next explains why these substitutions may not cap prices the way many expect.
And the third one is that they have to retool completely to be able to use copper in their production. So frankly, solar panels are the cheapest additional form of energy for utilities. And I could see governments become supportive. In other words, start to subsidize the cost of solar panels if their prices went up too much. There's obviously support for green energy. It's considered, low or no carbon source of energy. So that's a path I think that we're likely to stay on. So like I say, higher silver prices,
Yeah.
it gets complicated for manufacturers, but I could see something like that happen. Government stepping in and becoming supportive.
Okay, so going back to gold silver ratio, even at $5,000 gold, the gold silver ratio has collapsed from 100 to 46, so that's halved in the span of a couple weeks. In 2011, we can draw on that as an example of prior history. A prior president, rather, it bottomed out at 32.
That's right.
So at 46, if we assume that history repeats itself, silver's got a bit more room to climb.
That's right.
What's a fair gold silver ratio that you think could be sustained in the future? And by the way, as you recall, post 2011, this gold silver ratio started to trend back up again as gold became more favored relative to silver.
This isn't just a metal story. It's a policy story hiding in plain sight. Peter Krauth often emphasizes that solar isn't optional for utilities anymore, and retooling entire production lines to swap silver for copper isn't cheap or fast. If panel costs rise, governments have a track record of stepping in with subsidies, especially when green energy agendas are involved. At the same time, the gold-silver ratio, collapsing from 100 to 46 in weeks, echoes 2011 dynamics, when silver still had room to run before peaking near 32. Peter Krauth notes ratios often overshoot, not stabilize politely. Next, he explains why history suggests this ratio move may not be finished yet.
Exactly. So, if you look back at the last, say, 20, 25 years, the average in the ratio is pretty high. It's high. It's kind of moved higher over the last several decades. And frankly, it's been closer to about 55, 60. But what we do see, if we look historically, is that when the ratio starts to drop meaningfully the way it has lately, it tends to overcorrect, meaning that it doesn't just go back to sort of average of where it's been over the last few decades. It tends to go much lower.
Yeah.
So frankly, at this point, I would expect the ratio, not tomorrow, but that we're not that far off, but it could go to somewhere like 40 or perhaps even lower. And like you said, in 2011, it was at 30. So we don't even have to go to that level to get to a lower level than where we are now. And if gold stays where it is, that suggests potentially even higher silver prices. But in terms of what's sustainable, frankly, I think we could probably be in an area of over an extended period of time, somewhere like 50, 55. And, if gold stays where it is and silver rises, a 50 to 1 ratio at $5,000 gold is $100 silver, right? 50 to 1 on $5,000 gold. So I believe that, after a correction in the silver price, we're going to either move sideways for a while or start climbing again. Either way, on balance, I believe we are moving higher.
The ratio isn't reverting, it's behaving exactly like it always does before extremes. Peter Krauth highlights that while the long-term average sits near 55 to 60, sharp drops historically don't stop at the mean. They overshoot to the downside. In 2011, the ratio hit 30, and even a move to 40 today implies materially higher silver prices if gold holds near $5,000. A sustained 50 to 1 ratio mathematically points to $100 silver, reframing this as arithmetic, not speculation. Peter Krauth's key message is that corrections don't negate trends, they reset them. What comes next explains why sideways periods can still favor patient silver holders.
That it's hard to be a contrarian now. Are you insinuating that maybe now it's getting a little bit overcrowded?
That's a good way to think about it, because I think in the very near term, probably yes. I do think that if you look just, I'm not a technician, but if you look at the chart from a technical perspective, this is one of these parabolic runs higher. And typically, historically, you do get corrections, and you can get pretty significant corrections. Silver's known to be volatile, and that's why, thankfully, a lot of people stay away from it, and that, creates opportunity for those who aren't afraid of it. But I think that suggests that in the near term, we could be due for a correction. I've run the numbers. I've looked at this historically. If you look, for example, at the last big run, which was from 2001 to 2011, silver started out at $4 and ran to 49 and change in April of 2011. So that's more than a 10x. And during that decade, you had 5 corrections of 15% or higher. The average was 30%. And yet, despite multiple 30% corrections, you still went up more than 10x. So that's why I think that, it's all perspective.
The real risk here isn't volatility itself, it's mistaking a normal correction for a broken thesis. As Peter Krauth has pointed out before, silver's parabolic phases almost always invite sharp pullbacks, and history shows they are a feature, not a flaw, of long bull markets. Between 2001 and 2011, silver endured 5 separate corrections averaging 30%, yet still delivered a tenfold return, which forces investors to confront whether they are trading swings or owning a trend. The fact that silver scares people away is precisely why opportunity persists, a dynamic Peter Krauth repeatedly emphasizes. Next, he explains why understanding where we are in the larger cycle matters more than timing the next dip.
You have to know where you are in the bigger picture, in the larger bull. And so I think it's still quite early, but that doesn't mean we're not due for a correction to rebalance sentiment.
Okay, we're going to get Peter's rehash of his $300 thesis one more time. But before that, let's talk about what happens during this correction. What is the magnitude of this correction that we can expect in the past when silver peaked in past bull cycles, 2011, for example, 1980? First of all, in both those cases, it didn't stay above 49 for very long. In fact, only a day or two at $50 in 1980, and then it corrected at least 50, 60%. Exactly. More so in 1980. And the point I'm trying to make is, in those prior bull peaks, silver's correction did not recover.
Right.
So when you're talking about a correction that's going to follow here, and then it's going to go back up, I'll just point out that it hasn't happened in the past. What's different this time?
So what's different this time is that, 1980 was the end of the secular bull market. Silver had been rising for a decade.
Yeah.
And there were plenty of fundamental drivers, but at the end, it all became about sentiment.
The uncomfortable question is whether investors are anchoring to history without asking what kind of cycle they're actually in. Peter Krauth stresses that past peaks like 1980 and 2011 were sentiment blow-offs, where silver briefly touched highs before collapsing 50 to 60% and never recovering within that cycle. That context matters because many assume every correction is just a pause before higher prices, even though history doesn't automatically support that belief. The difference now hinges on whether fundamentals, not emotion, are driving price. Something Peter Krauth argues separates this move from prior manias. What he says next lays out why this cycle may not end the way skeptics expect.
Doubled multiple times in the last sort of few months. And if you look at the 76 to 1980 period, it went from $100 to $850. So that was 8.5 times. In 2011, it was not a fundamental run-up. I think that yes, we're at all-time highs, and it's uncharted waters, so to speak. But how did we get here? I believe that a lot of it is fundamentally driven this time, and I think that that's what makes it different. I mean, it's always dangerous to say it's different this time, but frankly, in many ways, it is different this time. And I think that's what's kind of given people, the relatively early investors, the conviction to get in and to sit with it until it's run to 50, 60. David, think about it like this. I am prepared to say that we're due for a correction. And part of it is because it took 45 years to match that $50 level. So I had been saying that the next time it gets to 50, it's going to ultimately see that as a new floor. And it took 45 years to reach 50, surpass it, and stay above it.
The phrase "different this time" usually signals danger, but context determines whether it's denial or diagnosis. Peter Krauth highlights that the 2011 surge lacked deep fundamentals, while today's move follows decades of suppressed prices finally breaking a 45-year ceiling at $50. That shift reframes $50 not as a speculative peak, but as a structural reference point, altering investor psychology and risk tolerance. Early buyers staying through volatility suggest conviction rooted in supply dynamics rather than momentum chasing, a distinction Peter Krauth emphasizes when comparing cycles. Next, he connects this breakout to why the speed of the recent move actually strengthens the correction case.
And then it took 3 months to go from 50 to 100.
Yeah.
And so that's why, from 45 years to 3 months to go to a double from 50, that's pretty aggressive.
Yeah.
And but as I say, everything that's led to where we are now has been more than anything fundamentally driven with these supply deficits, this silver being deemed a critical mineral by the US. China controlling 60 to 70% of silver refining. The U.S. looking at spending $2.5 billion on a critical minerals, a strategic minerals stockpile. Trump telling his trade advisors, we should consider the idea of price floors on these critical minerals. There's a lot of India now saying that you can use silver as bank collateral. I mean, it's on and on and on. And now you've got people like Bank of America. I think it's Michael Widmer who said that he thinks that, based on the ratio and so on, we could see anywhere. I mean, I'm not that aggressive, but he's saying we could see anywhere from, I believe it's $135 to $309 this year. I think that's unlikely.
Yeah.
But I do think we could reach the lower end of his range.
This isn't a momentum story anymore, it's a geopolitical and strategic resource story. Peter Krauth underscores that doubling in 3 months after a 45-year breakout is aggressive, but the drivers matter. US critical mineral designation, China controlling 60 to 70% of refining, and a proposed $2.5 billion US stockpile all signal state-level urgency. When governments talk about price floors and banks discuss triple-digit targets, narratives shift from speculation to security. Peter Krauth cautions that while extreme forecasts may be unlikely, even conservative outcomes reprice risk dramatically.